Now, a third way to really identify liquidity is really just a combination of the two previous videos that I recorded about liquidity. You can go and check that out. But uh, the way we identify this, the third way of doing liquidity is really when there's breaks like this happening to the downside, and then there's obviously a higher high happening up to the upside. The liquidity is sitting inside this range in here. It's in here doing this, right? Let's do double tops, double bottoms, and then eventually the liquidity is being taken out from the upside and the downside right here, for the market to continue moving, down, right? So let me just show you more in a more detailed fashion here. When price is pushing down, it's just consolidating, right? And we don't know where price is going right now, right here. And then price just breaks, does another break. We can do this again. Here, here, and then here. Okay, so when the market's in this phase where price is pushing down and then consolidating and pushing down and consolidating, inside these consolidation periods, there's what we like to call, liquidity, where we can actually identify liquidity here, here, and here. And this is very important because we know we're still in a downtrend, but now we have to identify where to sell, right? And where all this manipulation is going to apparently happen, like right here, for example. The sellers who sold here, there was manipulation where the banks went up and took out all this liquidity here, and now they're taking all this equal liquidity down here. Okay, now here's more liquidity here. Here's more liquidity here, right? So when banks took this form of liquidity and the double bottoms right here, they're making another low. They're pushing price up. They're tempting the other traders, the retail traders, to pretend to make it feel like the market's actually going to be pushing up, like it's breaking structure right here or whatever, maybe right here. It's making you think that price is actually going up, when in fact price has always been going down. And here's another form of manipulation of liquidity right here and right here. So what do banks do? They come and knock out the buyers. They come out and knock out the sellers, and price continues its own direction, again making another low, taking out this form of liquidity and this form of liquidity. So that's how it's done, right? So let me show you another example here on the chart right here. Let me just delete this right here. So here is, excuse me for my throat. Okay, so here's a break, right? And now we have to find out where the manipulation is going to happen. So when prices, when the market's moving like this, right, we have to understand that when price is doing this, there's a liquidity right here, and there's liquidity sitting, well, not really at the bottom just yet. I mean, this could be considered a double bottom right here and right here. But watch how the banks take out the liquidity. Look how they just broke above this the double top here, right? They took out this liquidity here. And now they should be going, now since we're in a downtrend, right, the market's going to decide to come back down and take this liquidity out. Let's see what happens. Okay, look what happened here. There's a double bottom here too, again, actually, another double bottom. So the banks are going to have to take these guys out, because whoever bought here is buying in the wrong direction. I mean, they're trading in the wrong direction. So let's watch. There we go. See? That's how you can see where liquidity is. So what do we do as traders? We trade where liquidity is. We trade with the banks, and we trade towards liquidity. That's the only way to win this game, is to really trade where the liquidity is, where the money is.